But there are people who stay in a place where it's naturally a shared resource. The house belongs to my employer and there's some borehole, but they pay water, and they pay power, maybe they have solar, and they pay power. If you can't arrive at the actual cost of that, the commissioner actually has prescribed rates. The water is 500, electricity is 1500 a month. But don't take the prescribed rates if when there's an audit, KRA will see their water bill and they take 6,000, right? Then, fringe benefit. A fringe benefit is a low interest or no interest loan. So this usually happens with directors of companies. The company gives you a loan, they don't charge you any interest. But that, the difference between the market rates, and the commissioner usually prescribes a rate every quarter, and right now the commissioner has prescribed a rate of 7%. So the difference between the rate the employer gave you and the market rate is a taxable benefit. But a fringe benefit is actually taxable on the employer. The employer can actually give you the fringe benefit, but they have to add that back in calculating how much tax they need to pay. So the employer actually pays tax on that. So now the value of your housing. If you're given a house by your employer and tax manager, your employer should take 1%, or you, when you employ people, 1% of the value of that furniture per month, and to add it to the employment income. Right? Value of the premises, the value of the house now. You take 15% of all employment income, which means you take 15% of my salary, my bonus, my car benefits, my bills, my airtime, right? And you charge that as a housing benefit. So for agricultural employees, it's different, it's 10%, but you actually reside on the farm, right? So this is the scale. You will see here from the scale, you start at 24,000 is 10%. But there is actually a relief, a monthly relief of 2,400 that makes it so that if you earn 24,000 and less, you actually don't end up paying the right? And then you'll see here that the net, this is like 8,300 or so, is 25%, and anything under this is 30. So between April and December 2020, there was actually a reduction in the rates, pushing people from the effects of corona. So there has been a revision, but we are actually still better off than we were before April. So this rate is actually lower than the rate that was in existence prior to corona. So I want to mention something, maybe we can go back regarding this benefit here. So everyone knows about this personal relief. But what is less commonly known is the other reliefs that result in a refund. If you have an insurance, like health, education, minimum of 10 years, you can actually claim 15% of the premium you paid, up to 60,000, and that amount if you paid becomes a refund. So that is how refunds arise. Or if you have a loan, you took a loan, a mortgage loan from a company to either buy a new property or to develop an existing property, you can actually get a benefit, a tax benefit of up to 300,000 a year of the interest, not the principal, the interest. So it's actually, if you are in employment, it is in your interest to actually take a mortgage, to make insurance, because you actually get a benefit, you get a tax benefit up to those limits. So that is how refunds arise. Someone mentioned they have a refund. If your refund doesn't arise from either one of those, either you have a valid exemption certificate, right, the people who are valid, maybe you're a person living with disability, or you paid, you see this 2,400, maybe your employer didn't give you that amount. Or you have a mortgage or insurance, that's how you get a refund as an individual. So if you have a refund arising out of that, please pay career to refunds. So withholding tax, I want to mention withholding tax hand in hand with fair demand, because a common misconception, especially among professionals, maybe even persons like in your industry, is that when I do a job for someone and they withhold 5%, you will get a tax. That is not a final tax. You need to come and bring that amount. If you are paid 500,000 and the person who gave you the job withheld maybe 25,000, you need to now come and declare that full amount. Then the return will charge you fair one on that graduated scale. You deduct the 5% you had already paid, then you pay the difference. But the difference is that If you earn that business doing a consultancy or something like that, you can deduct expenses that relate to that. Maybe had to pay for rent, or if I bought a laptop for that job. You see, there are those expenses that you can deduct. What you cannot come and deduct now is those personal expenses. You cannot deduct that, but you can actually deduct your expenses that you incurred in generating that income. So the 5% is for management professional, contractual fees is 3%. What's important to note is that withholding tax is not an additional tax. People sometimes think you're now going to charge another 5%. It's just a system that's put to create accountability. A withholding tax certificate tells the commissioner, I did a job for so and so, and we tell 5%. So if you don't declare, the commissioner comes and tells you, I know you did a job for this person because that person already paid me the amount that they paid, right? So turnover tax, here is the tax we're talking about, business income. If you have business income that is between 1 and 50 million, then you can register for turnover tax. The rate is 1% of gross monthly sales as a final tax. Is actually quite low. Honestly, this is a very good obligation for companies that have that kind of income. Even though you don't deduct the expenses, 1% is a very favorable rate. 3% before April 2020, and it is actually one of the changes that was introduced during COVID that still persists, right? And it's a final tax. You don't now subject income that you pay turnover tax on to other income tax. But there are exemptions. The exemption, of course, is if your income is over 1 million or under 1 million or over 50 million. You now come and declare your annual return. Of course, you don't subject your employment income to turnover tax, has already been subjected to as one. Rental income, we will discuss. You cannot subject it to turnover tax because there's already a regime for that. Okay? So residential rental income, I had mentioned that if you have rental income, you should actually register for monthly residential rental income. Initially, the threshold was if your rental income is between 10 million and 144,000 a year. But that was revised. It's now 288,015. So if it falls outside that bracket again, you bring it to your annual return. So under MRI, again, it's a very simplified return. You can actually file this return on your mobile phone. You pay 10%. It's a flat rate. You don't deduct expenses. But if your income, rental income is above 15 million a year or below 288, you declare your annual return. You're allowed to deduct expenses that relate to the generation of that income. Yeah? So you can deduct, if you're an agent, you can deduct that, pay for garbage collection, but you cannot now come under your rental income and deduct also your own personal expenses. Right? So the due date for the turnover tax return and the monthly rental income tax return is 20th of the month, following the month in which you earn the income. So right now we are in in March. So by March 20th, you should have paid either turnover tax if you're registered or income you earned in February. Okay? The same applies for monthly rental income and turnover tax. So VAT. With VAT, there are two things I want to mention. The first thing about VAT is that VAT has something called a tax point. And a tax point is the point at which if you are registered for VAT, you should pay VAT. So it's the earlier of these days. The day you give an invoice, the day you receive payment, or the day you deliver goods or perform a service, whichever comes to it. And this is a very contentious issue because, so the threshold for VAT is 5 million. If in any 12-month period you make sales of vatable products or provide a vatable service, you should register for VAT within 30 days. So, and this 12-month period isn't like a calendar year. Now we are in March. Go back 12 months. You see, have I reached 5 million over the last 12 months? Yes. Within 30 days, register for VAT. But now, the next point is now what we are referring to as a tax point. And I say that because a lot of times, small businesses, somebody will deliver goods and I wasn't paid. Then I reconduct an audit. And then you'll be saying I wasn't paid. But you see, under the VAT Act, there is that tax point, the point at which you should declare that you have VAT. And actually, what I encourage is that you observe the tax point. If you cannot make full payment, that amount that's due, go to your debt office. The debt management office can actually give you a payment plan. Okay? So there are 3 rates of VAT. There are the exempt goods, first of all. Those are the ones that are not subject to VAT. You don't charge VAT. You don't claim VAT. So zero-rated goods, these are goods that the rate is 0%. And what that means is that I can't charge output VAT, I can claim my input VAT. So if you are exporting, maybe in Kenya you sell something, or you provide a service that is actually taxable, right? So we will establish a format that's supposed to become like charge VAT if I reach the threshold. If I export that service, it becomes zero-rated. And what that means is that I can claim input that I incurred in generating that service. I have a commercial premises, I paid rent, I can claim the input, even though I don't charge. And so what happens is that when you hear about VAT refunds arise as a result of this. I provide a vatable service that is now zero-rated because I exported, or I supply zero-rated goods or services, right? So this is different from somebody who I made sales that were lower than the purchases I made. You see, both of you have a credit, but the other person can't claim for a refund. That other person has to continue to run the business until such a time as their output is more than their input. But this one is also in a refund. Okay? Then we have these goods here, the goods that are chargeable at 8%, that's petroleum oil, and 16% is the general rate. That's the rate that you pay for goods and services in the supermarket, right? So the rate has been revised April to December when it was 15, we are now back to 16%, but the return is intelligent. So if you put the correct date, you have 6 months to claim your input. So if you purchase something, the commissioner gives you 6 months to claim that input. But if you sell something, you must declare it the day it's perfect. So penalties and interest. What is of note here is that first, the penalty for employment income is very high. If you employ someone and you're registered for KEC, the penalty is 25% of the tax due or 20,000, because you're denying your employee the money and you're denying the government the money. So that's different, for example, from excise and VAT, which is 5% and 10,000. So this is a very high rate. Sometimes people misregister for pay as you earn. I went to cyber, then the guy asked me, "Unanipanga nini?" And pay as you earn. Then he adds the obligation for you. If that's the case, then you need to actually apply it for the removal of obligation. So the rate for transfer tax and loans are increasing, so that the percentage is very low, 1%, and the interest for late filing is also very low. So now we talk about the voluntary disclosure program. So the voluntary disclosure program is actually a confidential program that will run for 3 years. And what it does is it allows you to declare to the commissioner any income that you had not declared for the last 5 years. From 2015 to 2020, if you had income that you had not declared to the commissioner, you can come and declare that income under the voluntary tax disclosure program. And the commissioner will actually give you remission of interest and penalty on that income, as long as you declare fully, right? So we will see how it works in the following slide. So you can join the program, except if right now you're already under audit from KRA, you cannot come and say, "I want to voluntarily disclose tax that the commissioner has already discovered." Yes? So if you're under audit, you cannot actually apply. But otherwise, if you don't have an audit or an investigation or a compliance check, you can actually apply for the voluntary tax disclosure program. So all tax heads are covered. Again, we mentioned that if you have tax that you had undeclared from 1st July 2015 all the way to 30th June 2020, so that's a 5-year period. And then these are the tax heads, whatever tax head you download the form in the system, and then you fill out the form, present it to your tax service office, and you will assist you with that. So if you come in the first year, let's say Kenyans have peculiar habits, don't be those Kenyans. So if you come in the first year, you declare and pay in the first year, commissioner gives you a 100% remission. You come in the second year, it reduces to 50%. Coming in the third year, you only get 25%. Still, we will be asking, please give us an extension, yes, 10%. So digital service tax, I think someone mentioned that. Digital service tax is charged for the provision of services on a digital platform. Came into effect in January 2021. And so it's for various services, we are going to see that it applies to both residents and non-residents. For non-residents, digital service tax is actually a final tax. But if you're a resident, whatever digital service tax you pay, you can actually come and reduce. Remember when we did that calculation of installment balance of tax, you can actually come and reduce that amount to balance of tax, you can reduce it for whatever digital service tax you pay. Right? So if you don't have a permanent residence in Kenya, you can appoint someone to do that. So this is what now, because you know on a digital platform we can't say that the services were, the service was performed in Kenya purely if you are in Kenya. So this is what now, located in Kenya, these are the parameters that the commissioner will use. So the first is, if there is a credit facility provided by a financial institution in Kenya, right? You can't say that they pay for this services from the state, therefore I don't pay. As long as the facility is provided by a financial institution in Kenya. Then the user accesses the digital interface from a device located here in the country. That is the most direct actually when it comes to what is located in Kenya. Then, also here, where you are acquiring goods or services, when you're acquiring supplies or services using a protocol address that is registered in Kenya. Finally, that you have a billing address in Kenya. What is important for us to note is that this applies actually to services. When you are actually providing a service on a digital platform. If you're using a digital platform, tell people I have a gym, then you're going to pay digital service tax, because that is actually you're using it to advertise, right? If you're selling goods or something like that, if I'm using a digital platform to tell you come and buy my goods in my store, you don't pay GST because you're actually not providing a service on that digital platform. It's different if I'm on the digital platform and I'm being paid to provide the service of promotion. Now I'm on my Facebook page and I'm telling people I'm paid maybe 60,000, 70,000 by a company to advertise their service. You are providing a product on a digital platform. But if you're using the digital platform to advertise for goods, physical goods, then no, that is not. So here we have a list. You can just read the list of what the scope of what is a taxable digital service. Downloadable content, if you are providing games and the like. I think this is what is very common, also subscription, magazines, and people will charge to subscribe to their blogs or something like that. You're providing a service on a digital platform. So we can go on to the next one, also streaming, movies and the likes, Netflix and what have you. Another common one that you see is e-ticketing here, people who will sell you tickets. So that person who is providing the platform, the ticketing platform, is being paid by whoever is selling the ticket. That is who now is supposed to come and pay digital service tax. So the commissioner has added this, any other service provided through or delivered through an online digital platform, because these services keep evolving over time, and so this list cannot be exhaustive for time immemorial. So this just shows you that it's a simplified return, a very simplified return to pay for GST that regulates in the 20th, very much like VAT, MRI, and turnover tax. And if you're not a resident, you can actually use a residential business for purposes of completing GST. So there are exemptions, of course, to GST, and some of those are the one that is most noteworthy here is online services provided by government institutions. The platform that government uses where you can apply for your license, e-citizen, right? You're being given a service to a digital platform, but the government provides it. So that's one that is
But there's always a fee.
Yeah. So there's a $50 fee, it's a convenience fee. But that fee now is not subject to GST. Yeah? So there's that fee that is chargeable now is not subject to GST. Even though it is chargeable 50 shillings, whoever it is who provides that platform actually pays tax, yes, on that service they provided. So the rate is 1.5%. We've seen that GST you can come and reduce against your